Okay, welcome everybody. I think we'll start settling down so we can begin. Good afternoon and welcome to this side event on addressing natural catastrophe protection gaps. My name is Jonathan Dixon. I'm the Secretary General of the International Association of Insurance Supervisors, the IAIS, at the Bank for International Settlement. I'd like to welcome you warmly, both those in the room and those tuning in to the live stream of this event. And of course, to firstly thank you to the G20 presidency for enabling this side event and for hosting it. I'm particularly fond of the fact that it's hosted in my old home country, in a part of the country close to my heart, but also as with many regions, tragically, a region of the country that was affected by natural catastrophes, and the flooding in this part in KwaZulu-Natal in 2022 that tragically led to over 400 lives being lost. And while the perils and circumstances may be different, the tragedy of natural catastrophes are felt all over the world. So this side event will focus on the implications of growing insurance protection gaps, the important role of insurance solutions alongside broader disaster risk mitigation strategies, and the importance of cross-sectoral collaboration in taking action to address these challenges. We're very lucky to have an esteemed lineup of speakers and panelists to provide their perspectives, and the structure will be that we'll have three keynote speakers before we move into the panel session. But before I introduce the keynote speakers, I'd like to first warmly welcome to the stage one of our hosts and my former boss, the Governor of the South African Reserve Bank, Lesetja Kganyago. Thank you, Lesetja.
Thank you very much, Jonathan. You clearly have not learned from the previous jobs. You work for me once, you will forever work for me. I'm still your boss. Distinguished guests, finance ministers, central bank governors, ladies and gentlemen, good afternoon. It's an honor for me to provide the opening remarks this afternoon, addressing the growing natural catastrophe insurance protection gaps. This is both urgent and consequential for both developed and emerging market economies. The frequency and intensity of natural disasters are increasing, causing significant damage to property and infrastructure, impacting lives and livelihoods, and resulting in tremendous loss of life. The risks are global, but the burden is deeply unequal. In many emerging and developing economies, the costs of these disasters are magnified by limited financial and significant lack of insurance protection. Globally, it is estimated that over half of natural disaster losses remain uninsured. In EMDEs, that figure often exceeds 70%. South Africa, for example, is estimated at 71%, and India at around 91%. This leaves households, businesses, and governments dangerously exposed, compounding economic shocks and slowing development for years or even decades. From a central banking perspective and financial stability perspective, this is not a peripheral issue, but a core issue. uninsured losses from natural disasters can undermine economic stability, threaten the solvency of financial institutions, and disrupt credit flows. Moreover, when governments must step in with emergency funds or debt finance reconstruction, it places additional strain on already limited fiscal space. For central banks, policymakers, and supervisors, bridging this protection gap is part of building macro-financial resilience. It calls for stronger risk-sharing mechanisms, improved data and modeling of climate-related risks, and innovative insurance solutions such as parametric instruments, catastrophe bonds, and regional risk pools. More importantly, it requires a coordinated and collaborative effort across governments, insurance supervisors, the private sector, international organizations, multilateral development institutions, and local communities to embed financial resilience into our climate and development strategies. We must recognize that resilience is not only built in the aftermath of disasters, but in the deliberate and proactive planning and actions before they occur. Insurance is not a luxury. It is a foundational and critical tool for sustainable development. In the conversations that follow, I would encourage all of you to think boldly about how we can address this insurance protection gap beyond innovative products to include appropriate policies and regulations that are inclusive, accessible, and tailored to jurisdictional circumstances, especially considering the realities of EMDEs. I looked at the panel that has been composed here, or that has been put together. It's an excellent panel, and I had to cut another meeting to make sure I am part of the deliberations. Thank you.
Thank you, Governor, very much for those fantastic comments and really highlighting that this is a core issue. And we're very fortunate to have three distinguished keynote speakers with us to underscore that point, highlighting the growing importance of the topic of insurance protection gaps. So I will introduce quickly all three keynote speakers before then asking them to take the stage one at a time. Firstly, to welcome the President of the World Bank Group, Mr. Ajay Banga, who's been President of the World Bank since 2023, and Mr. Banga's leadership spans across the international and private sector, having previously been Vice Chairman of General Atlantic and before that President and CEO of MasterCard. President Banga will be followed by the Honorable Minister of Finance and Minister of State for Financial Services in Japan, Katsunobu Kato, and Mr. Kato previously served as Minister of Health, Labour and Welfare and Chief Cabinet Secretary. He was first elected to the House of Representatives in 2003 and has since been re-elected 8 times to represent his constituency in Okayama. And finally, we'll welcome to the stage the new chair of the Financial Stability Board and Governor of the Bank of England, Andrew Bailey, who of course brings a rich supervisory and central bank experience to the discussions, having previously served as CEO of the UK Financial Conduct Authority and also previously Deputy Governor for Prudential Regulation and CEO of the PRA, as well as other senior roles at the Bank of England. So please join me in welcoming our distinguished speakers to the stage, starting with President Banga. Thank you.
I was telling Andrew that when you say esteemed speakers, you normally mean central bank governors. The rest of us are just hanger-ons. So when a natural disaster strikes, actually, in terms of the number of people, 1 in 5 people in developing countries basically risk losing their income and assets. And in Africa, it's double that, it's 40%. In dollar terms, it's even higher, as the governor was pointing out. And the fact is that too often the costs of these catastrophes end up on the public balance sheet as debt that none of these countries can truly afford to have. Insurance can help, but for insurance to work, high-quality development is a necessary precondition. It simply cannot function in the face of poor infrastructure, unreliable data, or chronic underinvestment. Without that foundation, all of you who are in the insurance business know insurance premiums will be just too expensive. Building resilience into everything we do, therefore, is the first step. It's a fundamental step, and it's smart development. So at the bank, through our country partnership frameworks, these are strategic plans we do with each country. We work directly with governments to design these plans that address their most pressing and potentially transformative priorities. It could be critical infrastructure, it could be expanding education and skilling programs, or private sector investment, or healthcare, or energy. The idea is you recognize the individual realities that country faces. Many of them are working to grow their economies and lift people out of poverty while confronting rising temperatures, more frequent floods and droughts, and increasingly severe storms. And so what we're trying to do is to help them pursue development goals that reflect their reality. Build a road that can withstand a flood. Build schools with insulation and reflective roofs so outside temperatures don't impact learning inside. Help farmers source drought-resistant crops so a dry season doesn't wipe out the harvest or income. Essentially, this is doing development. It is schools and bridges and roads, but doing it the right way. Smart, high quality, and fiscally responsible. Build resilience into everything we do. That's what our clients want. That's where we are focused. And as a result, the just concluded financial year, we surpassed our own projection of allocating 45% of financing to such challenges, and we have actually crossed 49% this year itself. Because that's built into what we are doing. It's not a target. It's the derived result of doing things the right way. Within that, we've aimed for an even split between what we call adaptation and mitigation, the point you were making in an earlier speech, Governor. Adaptation includes the examples I just mentioned. Mitigation includes shifting freight from trucks to rail or growing rice to reduce methane. To achieve that balance, we've actually significantly increased our adaptation financing, the point we're addressing here, up to 10 percentage points in under 2 years. The problem is there's a lot of work still to do. Even the most resilient investments are not invincible. And that's why stronger insurance markets are essential. The problem is the insurance gap in the developing countries is vast. And as the governor said, when catastrophe strikes, sometimes 90% of losses go uninsured. And why is that? Low affordability, limited financial inclusion, underdeveloped markets, and weak regulatory and supervisory systems. Several steps we can take to help and are doing. First, integrate insurance into a broader package of financial services. Beyond savings and credit, deliver it digitally as well. In the Horn of Africa, with the World Bank's support, 13 insurers and 11 financial institutions are now offering bundled digital services, including credit and livestock insurance, to over 3 million farmers and ranchers in Ethiopia, in Kenya, in Somalia. Payouts, by the way, are triggered automatically when you use satellite data during the start of the dry season, so essentially households get to take early action and avoid losing their herds. Second, expand public-private partnership to broaden coverage. So in Morocco, we supported a dual catastrophe risk program that blends market-based insurance with solidarity mechanisms, extending coverage to lower-income households. After the 2023 earthquake they had, it enabled nearly $300 million in payouts to affected families. And third, the regulatory and supervisory framework, which is required to unlock market growth and build trust. And we're working with countries like Bangladesh and Nepal to modernize their insurance regulations and adopt risk-based supervision, making their sectors more stable and transparent and capable of scaling. Fourth, link private insurance to public social protection programs. So in Malawi, we're supporting the government to develop a safety net system backed by private insurance. It now covers 600,000 of the poorest citizens with drought-triggered payouts that provide rapid and targeted relief. Finally, and most importantly, you've got to scale these and get more. So in May, we convened our first World Bank Group Academy on disaster risk finance in Istanbul, focusing entirely on insurance. More than 20 countries came together to exchange experiences and accelerate the solutions. This work is backed by partnership with G7, G20, and of course, the IAIS. Kato-san, your leadership and Japan's continued leadership is essential to this effort. Working together, we can scale what works. We can ensure that development gains are not erased by a single storm, drought, or an earthquake. This is what matters for building people and economies who can withstand shocks and recover much faster when they inevitably will come. Thank you very much for your time.
And Minister Kato, please. Thank you.
Thank you. Ladies and gentlemen, it's my great honor to deliver the keynote speech at this official G20 side event. I'd like to extend my gratitude to the G20 presidency and the co-host, namely IAIS and the World Bank groups. The increasing the frequency and the severity of the natural catastrophe events is a global challenge, affecting both advanced economies and EMDs. In particular, insurance protection gaps arise when insurance cannot sufficiently cover losses caused by natural disasters. Insurance protection gaps prevent prompt recovery after natural disasters and are affecting the economy and the public finance. This G20 event aims to discuss global responses to these challenges, and it's indeed quite timely. These are two main factors that are widening the insurance protection gap. The first one is the low insurance penetration rate, especially in EMDs, due to underdeveloped insurance market and insufficient financial literacy. The second one is the increasing the frequency and the severity of the natural disasters, which is increasing losses for insurance to cover. In addressing those factors that are widening protection gaps, each stakeholder, such as international organizations, supervisors, and industries, has a role to play. To begin with, the role of the insurance supervisors includes assessing the gaps, improving the financial literacy, ensuring the better supervision and regulation, and incentivizing risk reduction. Supervisors can incentivize risk reduction through measures such as encouraging the industry to reflect risk reduction effect of disaster-proof facilities in insurance premiums. Japan strongly supports the efforts by the IAIS to emphasize the role of the insurance supervisors in addressing the insurance protection gaps. Next, since EMDs are facing particularly significant insurance protection gaps, it's important for policymakers to undertake concrete actions to narrow the gaps. I look forward to the ongoing efforts by the IAIS and the World Bank Group to provide the practical guidance and tools to assist the policymakers as supervisors in EMDs. In addition, the role of the insurance industry is critically important. I expected the insurance industry to make efforts towards raising financial literacy and risk awareness, incentivizing risk reduction, and developing new innovative products. This will contribute to the take-up of the insurance coverage and the development of the insurance market. Addressing the insurance protection gaps also provide opportunities for the insurance sector. I call on the IAIS to support such effort through sharing examples and knowledge. In light of the experience of the frequent natural disasters, such as earthquakes and typhoons, the Japanese government has been promoting the development of insurance market and enhancement of the financial literacy, as well as disaster prevention. Building on such experience, Japan has been at the forefront of global discussion on insurance protection gaps, including through the regional cooperation. I would like to take this opportunity to share with you some of Japan's relevant initiatives. The first is the promotion of the financial education in order to encourage individuals and companies to take up insurance coverage in line with their needs. It's critical to enhance the public understanding of the essential role of insurance in protecting us from natural disasters. In Japan, we established an organization to promote financial education through a public-private partnership in 2024. The second is a disaster prevention. In order to address the natural disasters with increasing frequency and severity, it's crucial to initiate risk reduction with the involvement of the whole society, as indicated in the Sendai Framework for Disaster Risk Reduction, which was adopted at the United Nations in 2015. In Japan, we developed a comprehensive and strategic disaster reduction policies under the framework, involving all members of the cabinet and in cooperation with the stakeholders, such as the academics and local governments, in particular ex-ante investment in disaster prevention, such as in earthquake and fireproof buildings, is effective in reducing disaster risk and therefore highly important. The third is regional cooperation. Japan has taken the lead in disaster risk financing in the Asia-Pacific region. For example, Japan established the Southeast Asia Disaster Risk Insurance Facility, CDRIF, with a view to enabling Southeast Asian countries to secure the fund for prompt restoration and reconstruction. We have promoted disaster risk financing as one of the pillars of regional cooperation at the ASEAN +3. I have set out my expectation for the role of the various stakeholders in addressing natural catastrophe insurance protection gaps and introduce recent initiatives in Japan. I hope that efforts by the IAIS and the World Bank Group, together with the experience of Japan, will contribute to the elimination of the factors that are widening natural catastrophe insurance protection gaps. Thank you very much for your kind attention.
And lastly, Governor Bailey, please. Thank you.
Well, it's a great pleasure to be at this very important event. I think it is actually my first speech as chair of the FSB, so I couldn't have made a better choice. It's not just because Lesetja told me I was making this choice, though he did anyway. But, look, it's a great pleasure to be here. Thank you to Lesetja, to the South African Presidency, to the IAIS and to the World Bank Group for putting all of this together. I wanted to start by actually just explaining where I think financial stability in the FSB fits into this, because it's actually important. And a point I wanted to start with is that people often, I think, not unreasonably say that financial stability is all about stopping bad things happening. And I wanted to say it's a bit more than that, because it's actually stopping bad things happening to enable good things to happen, to enable the supply of financial services to be predictable, to be there when it's needed, and to be there on the scale that's needed. That's really what we're about. We're not doing financial stability unless we're actually achieving that. And of course, sadly, there isn't a better example of it really than the one we're talking about, natural catastrophes. So the role of the FSB, in my view, is working with obviously the other authorities is quite fundamental to this, and it's quite fundamental to the job of financial stability, which is to assure that financial services plays its part in the functioning of economies. So, next question is, well, what do you actually do? And I think the FSB does, and not only does, should do, and will do a number of things. We obviously do surveillance, so we contribute to the identification of the supply of financial services, whether it's actually working or not, in other words. And if not, why isn't it working? And then, having identified where there are gaps and where there are causes, underlying causes for those gaps, and as the Secretary very well set out in his opening remarks, there are gaps, there is a gap here, then there is no question that we have a role to play in the problem-solving part of it, in saying how can we address the causes of these problems, particularly if those causes, of course, in our world are actually something to do with the supply of financial services. Whether that be a structural problem, that there is some structural failure in the supply of insurance in this case, or whether it's a cyclical problem, in the sense that the supply is too much related to a particular cycle, whether that be an economic cycle or some other cycle, and the coverage isn't consistently there, because it seems to me that there's two parts to identifying this problem. There is, if you like, the overall supply of capacity, but then there is also the question of ensuring that the capacity is always there, that it doesn't fluctuate, because quite clearly that would be a very serious thing, because the predictability, you can't predict natural catastrophes. We all wish we could. So the supply has to be predictably always there. And it always has to be there in a sort of smooth fashion. So that's where the FSB has an important role. Now, we fulfill that role working very closely with others, working with Jonathan Shigeru and his colleagues, with the World Bank Group, and indeed we'll work with almost anybody, actually, I think it's fair to say, because I always like to think that the FSB is very much a can-do organisation. We've seen enough consequence of the loss of financial stability to know that it's critical that we are always there and always thinking of the solutions. And the other thing I would say is that obviously part of that ensuring the supply of services is that when catastrophes do happen, as sadly of course they will and are, again, coming back to this cyclicality point, we don't see a withdrawal of cover as a consequence of some event. That we have got an industry that is there stably providing the cover, if you like, come what may. So I just want to finish by making a remark about another aspect of this, of course, is about the pricing of the services. Because that's, of course, another element of resilience. Because, again, if the pricing of the services, in this case the premium, is pro-cyclical, in this case, if it fluctuates hugely related to disasters and to events, then there's a problem. And there's a problem that we've got to be part of addressing. These issues are not easy. I'll give you one example. I'm not going to pretend actually that it's a catastrophe as such, but it's actually a UK example. We have a structural problem in the UK with flooding. And we have a structural problem with increased flooding and the fact that more of our housing stock is being built in areas that are subjected to flooding. And so we have had to, working with the government and the industry, insurance industry, come up with a reinsurance solution, which we call Flood Re, which is about essentially saying that if we want and indeed have to have more of the housing supply built in these areas, then we have to have a solution which ensures continuous insurance. We can't have people who say, well, it's very nice you built the house there, but I can't live in it because I can't insure it. And again, I think that's where in the finance industry and in the authorities, we have to be constantly attentive and also, frankly, at times imaginative to say, what can we do to solve these gaps? So I can assure you that the FSB is going to stay involved in this, as I say, working with our colleagues who spend so much of their time on it. And we will do all we can to support it. Thank you.
Well, thank you very much, President Banga, Minister Kato, Governor Bailey, for those very insightful comments, and I particularly took away the comment around building resilience into everything we do. And I think those comments set the scene incredibly well now for our panel discussion. And we're also very lucky to have a number of distinguished panelists joining us here today. And our panelists hold a number of positions in different sectors, different capacities, which I think is indicative of the key message, which is that addressing protection gaps is a challenge that requires a multi-stakeholder approach, multi-stakeholder collaboration involving supervisors, governments, the private sector, international organizations, MDBs, civil society. So very happy to have our panel with us, comprising, working from my immediate right, Shigeru Arazumi, who, in addition to being Vice Minister for International Affairs of the Financial Services Agency of Japan, is also the fantastic fantastic chair of the IIIS Executive Committee. Then we have Riccardo Barbieri, Director General of the Treasury in the Italian Ministry of Economy and Finance. Thank you, Riccardo. Dr. Hatice Karahan, Deputy Governor of the Central Bank of the Republic of Turkey. And last but not least, Mr. Antoine Gosset-Granville, Chairman of the Board of Directors of AXA, but also a member of the IDF Steering Committee, the Insurance Development Forum, an important partner on this topic. So let's kick off, and in the first round of questions, I think, talk a little bit about the scale of the challenge and the impact of the challenge. So Shigeru, if I could ask you, from your perspective as IIS chair, why do insurance protection gaps remain such a critical global challenge? And what makes the issue so urgent for supervisors, for policymakers? Thanks.
Thank you. Thank you, Jonathan, and thank you for your question. I think as previous keynote speakers have mentioned, this is an issue which faces severity and frequency of increasing natural disasters. And the protection gap is not only evident in the advanced economies, it's more clearly pronounced in the EMDs. So it's a global issue. So if it's a global issue, we need a global response, naturally. And in that context, we need everyone to work together on this. And we need coordinated action, particularly, as Andrew highlighted, this is a financial stability issue, but it also is a societal resilience issue. So it's an issue very important for regulators and supervisors. But why are we here at the G20 to discuss this? Because it has policy implications. Of course, the role of insurance is quite important in responding to NatCat. For example, it provides financial protections to households and corporates, enabling a faster recovery and reduces economic disruption, and also can incentivize, as Andrew mentioned, risk reduction and preparedness, helping to limit losses before disaster strikes. So here we see a very important role of insurance. However, as we have witnessed, because the frequency and severity of NatCat, I think the core objective of financial stability could be in question. For example, lack of insurance coverage can also create spillover effects to the wider financial system. So there we have to be very much mindful of that aspect. Also with supervisors and regulators who have mandate on financial inclusion and market development, it can mean that this would affect the most vulnerable segment of the economy and society. And it also can impact the future medium to long-term development of not only markets, but also for the economy as a whole. So what do we think about this? Financial stability, but also NatCat can have far-reaching consequences by key economic sectors such as agriculture, housing, infrastructure, and also public assets. Without timely action, the inability to address these gaps could undermine not only market confidence, it can strain public resources, as government often bear the financial burden of recovery and reconstruction, including for uninsured public assets. But most importantly, it can exacerbate economic and social vulnerabilities. And EMDs, as Lesetja mentioned, are particularly vulnerable due to the limited financial space, limited financial or fiscal space, underdeveloped insurance markets, and inadequate infrastructure. So this makes it imperative for supervisors to act now, working collaboratively with stakeholders including the government, the industry, civil society, and development partners such as the World Bank Group. So this will help ensure not only financial stability, but to build a more resilient society. And we need a multi-stakeholder approach to this, which aims for a comprehensive response, including insurance-based solutions and public-private partnerships. Let me stop there. Thank you.
Fantastic, and thank you. As we heard from Shigeru Ricardo, this is an issue that matters to policymakers, to governments, fiscal resource issues, societal resilience. How should governments, do you think, go about balancing constrained budgets with the costs and risks of inaction when investing in risk reduction and insurance solutions and the policy trade-offs there?
Yeah.
Thanks.
Well, I think normally when we talk about this theme of natural catastrophes, we think immediately about the public finances, and clearly this is a major factor, but there's also an element of welfare promotion, because obviously these disasters cause very serious stress for the population. Many people don't have coverage. When disaster strikes, sometimes the public sector is slow at intervening. So by having more protection also on the part of the private sector by insurance contracts, we can improve significantly welfare. And also incentivize good behaviors, because obviously if your insurance premium is also related to how you protect your infrastructure, your companies, say warehouses and factories, then obviously there is an incentive to adapt and protect against these catastrophes. I think the reason for asking an Italian official to talk about it is that, as we all know, there's no shortage of risks that we face in Italy, new and old. The old risks are, of course, we are a seismic country. We have lots of volcanoes, frequent earthquakes, flooding, even, let's say, before we saw these clear signs of global warming. But more recently, with the warming of the Mediterranean Sea, we have seen more and more events of extreme weather, and, of course, also fires. And that is in common to other southern European countries and elsewhere in the world. So there is clearly a strong motivation to do something about it. After lengthy consideration, we are now seeing a scheme for companies to acquire insurance being implemented. And one of the questions was whether the insurance sector could take such significant risk, especially when you have concentration and you need to spread the risk. For example, there's an area in Italy that has had flooding that is quite unprecedented because of this climate change a couple of times in recent years. And who would insure that part of the country? So the idea has been to use our export insurance company to contribute to the scheme, obviously with the government as a backup, but it means you only have a disbursement from the public finances if the first line of defense fails, and actually the second as well, their insurance. And that helps the insurance sector itself, insurance companies, to provide insurance. So this insurance becomes mandatory this year. The process will be completed at the end of the year, so it depends on the firm size. So from next year, hopefully, we'll have full protection, and we think it's an important step forward, because a survey revealed that we are one of the least protected countries in Europe. There is a significant protection gap at the moment for businesses. Last year, during an event on this topic, I also ventured into saying that one day I wouldn't mind seeing households taking insurance as well. And it did attract some attention from the media. But I think it's clearly the next step. And then one could think, at least in my mind, of infrastructure as being something that perhaps European countries could pool under certain circumstances. Of course, we know that some countries face bigger risks than others, but I think the full set of instruments that we need is obviously companies, households, and infrastructure. And the benefit, I went quickly over the topic of the public finances, but there's been a recurrent hit to the public finances because of these events. Clearly, if we can spread the risk and incentivize good behaviors from the private sector, hopefully the damage for the public finances will be reduced.
Excellent. Thank you. And Hatice, we'll turn now. We heard from Governor Bailey around the financial stability angles of this. How might this rise in natural catastrophe insurance protection gaps affect financial resilience and the broader economy beyond just the insurance industry?
I think they are just a part of a growing. They are just a part of a growing pattern of global disruption spanning continents. Fact number 2. Adaptation is crucial, of course, but current support remains far below what is needed. Reports show that only 5% of climate finance is allocated to adaptation efforts. Again, some numbers would be useful. Between 2018 and 2022, emerging markets and developing economies received over 90% of the $270 billion in adaptation finance. Yet, projected annual adaptation needs for the following years exceeds another $200 billion. So, and most of this will be required in EMDEs. So the shortfall is widening, and so are the risks. Fact number 3, insurance markets. They remain significantly underdeveloped in many parts of the world, especially, again, in developing economies, and this represents a major weakness in climate finance or climate risk preparedness. Globally, insurance penetration is highly uneven. Again, some numbers. In 2023, the highest insurance penetration rates were found in Luxembourg with around 27%, and Hong Kong with 18%, and South Africa with around 13%, followed by the United States and the United Kingdom. But of course, even among these leading performers, there is wide variation in terms of the content of the insurance penetration. But let me add that the OECD average was 9.1%. And fact number 4, fiscal space. Fiscal space is limited in many developing economies, and some of these countries are more vulnerable to natural catastrophes just because of limited financial resources, weak infrastructure, and low levels of insurance coverage. So I've listed 4 main facts, and against this backdrop, as for your question, the macroeconomic consequences of natural disasters unfold through several key channels. First, natural disasters create large reconstruction costs and impose long-term fiscal pressures. They damage capital and labor, they destroy critical infrastructure and displace people, undermining investment, productivity, and growth. And when insurance coverage is low, the financial burden shifts to households, corporates, and governments, diverting resources from development priorities and widening fiscal deficits. And let's admit, governments often bear much of the cost. Second, natural disasters distort labor and housing markets by driving mobility and migration. Mass displacement caused by NatCat events leads to labor supply disruptions and demographic shifts, and influxes to non-affected urban areas can strain housing supply, raise rents, and create mismatches between labor supply and labor demands. And third, inflationary pressures. They often follow in the wake of natural disasters. How? Simply supply chain disruptions, agricultural losses, or surging demand for construction materials. They can all drive localized inflation. And without effective policy intervention, these pressures may spill over into broader and persistent inflationary trends. And lastly, financial system stability, as mentioned before, it can be compromised. Why? Simply because disaster-related defaults push up NPLs, particularly in vulnerable regions. And if these pressures are not contained, financial stress may spread across the system, weakening balance sheets, tightening financial conditions, and reducing confidence. Well, of course, the effect of all these channels depends on the size and severity of the disasters. But one thing is clear: climate adaptation is not just an environmental issue. It is a macroeconomic imperative. What Benjamin Franklin said 3 centuries ago is timeless, I guess. By failing to prepare, you are prepared to fail. In this respect, scaling up adaptation finance, expanding coverage, insurance coverage, and building financial resilience must be central to our policy agenda. Thank you.
Thank you very much. And Antoine, lastly, the Insurance Development Forum was set up precisely to talk about addressing this challenge. How can insurers balance the need for, on the one hand, a sustainable business model, but also on the other hand, we heard the need for accessible, affordable insurance to help address this gap? What are the limitations on what the private sector can do on its own?
Thank you, Jonathan. I guess it is interesting to, when we discuss insurance protection gap, to also have the views of insurers. What I would say is that from the insurer standpoint, protection gap is a systemic issue, because the purpose of insurance is to protect against all sorts of risks. NatCat, of course, but also the other risks which may happen. So the issue is not only NatCat protection gap, it is broader than that. Coming back to your question, I would say that protection gap is a pressing issue for 2 main reasons which have already been addressed by other panelists. The first one is that high protection gap means that communities are less resilient. And in case of serious shocks, economies can be destabilized. And the second one is that without insurance, government and people and individuals bear the full cost of the shocks, of disasters. What does that mean for insurers? 3 things. First, protection gap is an obstacle to economic growth. Second, it generates social inequalities. And third and last, it generates a lack of trust. It could generate a lack of trust vis-à-vis the industry, vis-à-vis insurers. And in that sense, tackling insurance protection gap is not just important for business, it is essential for long-term viability of our industry. If I move now to the other part of your question, which refers to the way to combine sustainable business models with affordable coverage, I think we could play on 3 main levers. The first one is investment. And we should never forget that insurers also are investors. And they can invest in resilience, in risk reduction, and they should invest in these assets. And we will certainly come back to that later. The second lever is insurance products. And we have to conceive new products allowing to combine risk-based pricing with social consideration. At AXA, we have developed a very ambitious, inclusive insurance offer with affordable, simple, affordable products covering the main risks people, individuals, or companies are facing, and especially in emerging markets. And this offer has a lot of success, a great success. The third lever is what I would call public-private partnership. And that's important, especially on CatNat, on natural catastrophe. If we want to invest enough in resilient infrastructure, we need to have a combined approach with public guarantees or involvement and the direct involvement of private players, of course. But that's the same for insurance. If we want to have a good cover of extreme event, we will have to develop a mixed formula with state guarantees. Riccardo mentioned what has been done in Italy, which is quite interesting, but we should go beyond that, and we should generalize this public-private approaches.
Good. So thank you very much. I think we've heard a lot of compelling reasons why this issue matters. Now, in the second round of questions, let's turn a bit to what can be done about it. What is the solution? And Antoine, I'd like to stay with you because I know the IDF has been thinking about these issues for quite some time, and has also had a number of very interesting projects and initiatives, particularly in emerging market and developing economies. So how do you, maybe you can expand on this theme of collaboration between stakeholders, and can you share examples where such partnerships have been particularly effective, and what lessons have been drawn along the way? Thanks.
Yes, you're perfectly right, Jonathan. IDF, which is the Insurance Development Forum, for those who do not know very well this forum, the IDF has been set up precisely to put all the interested parties around the same table and to propose collective solutions, especially on protection gap. Just a few words and numbers about IDF. IDF that gather 118 members coming from the private sector, public entities, civil society, and academics. And over the last 5 years, IDF launched about 45 projects, concrete projects, benefiting to more than 60 million people. So that's serious numbers. Just a few examples to answer your questions. First, on risk modeling, IDF organized a workshop with 100 supervisors in emerging countries to help them to build capacity to address evolving risks and protection gap. On risk financing solutions, a number of public-private partnerships have been put in place. I could quote, just as a matter of example, a program for flood coverage in Nigeria, which benefited to 8 million people. I could also mention a program for drought insurance for small farmers in Mexico, and a similar one in Syria, just to give you some examples of programs to which AXA participated. Last example, investment in resilient infrastructure, which was mentioned before. We recently launched a fund which is specialized on mid-size infrastructure projects in emerging countries. And what is interesting with this fund is that it involves several large players of the industry who decided to invest in this fund. It also involves DFI with a strong involvement of World Bank, which is a very, very, very important signal to the outside world. And the fund is managed in quite a professional way. We gave a mandate to BlackRock, to a specific team of BlackRock to manage the fund. And from my standpoint, it is a unique example of a joint public-private approach to speed up, accelerate investment in resilient infrastructure. Just 2 words on the lessons which can be drawn. I see 2. First, insurers obviously can have a decisive contribution to address protection gap through improvement of risk awareness and through innovative insurance solutions. Parametric offers have been mentioned a while, but there are also micro-insurance solutions which can be provided and risk transfer mechanisms which have been put in place. The second lesson is that prevention and risk reduction require a strong public involvement. That's clear. Co-financing of projects, decisive action to remove barriers to insurance solution. There are a lot of fields where the public bodies can concretely contribute. I'm convinced that forums such as IDF can help to discuss and put in place these good options.
Great, thank you. And continuing a bit this theme of partnership in finding the solutions, we'll turn to the supervisory perspective. And I have to say, in the IIS, in fact, under your leadership, Shigeru, back in 2023, I think sort of crossed the Rubicon on this in terms of clearly stating that this issue does matter and it should matter to supervisors, regardless of supervisory mandate. And since then has done a lot of work. But what the work that's been done on that, about what role insurance supervisors can and should play in helping to address. Maybe you can talk about that and some examples.
Thanks, Jonathan. I think that, yes, we began. Yes, thanks, Jonathan. I think we did a call for action paper in 2023, which first took on this, and there was a lot of debate actually about how do we understand this with respect to financial stability. And the mandate of insurance supervisors can differ, but how do we come together on this subject? And it was quite an intensive discussion on how do we understand. And in conclusion, we said, and I think what Hatis mentioned was a part of this, is that if we don't close this gap, it will affect financial stability. So in the end, I think there was broad agreement that this was a financial stability issue, regardless, and that would be, very important regardless of the mandate. Some of the supervisors do have mandates on financial inclusion or market development, but regardless of the mandate, we should work together on this. And we had a call of action paper 2023. We've done joint work with the World Bank to provide an input paper to the G20 Presidency Sustainable Finance Working Group. Let me touch upon several points that I think is important. So where do supervisors start? Supervisors always start with data. So data is important in this aspect. How do we collect qualitative and quantitative data? That's a very important point. How do we encourage development of NatCat models for financial institutions, stress testing, scenario analysis? These are all very important, very authentic way for supervisors to approach these issues. Let me give you one example of what's happening in Peru. Peruvian are not probably here, but the financial regulator analyzed the coverage of the NatCat risks across the country by using detailed data on location, building characteristics, and economic exposure. And they looked at risks such as earthquakes, tsunamis, and floods. The analysis revealed that there's a significant protection gap with only about 800,000 insured properties out of the estimated 10 million nationwide. So that's about perhaps 8%. And what's distinct here is that the regulator also collaborated with the Ministry of Finance. So there's a cross-government sort of collaborative effort here to improve the data collection for public assets supported by enhanced disaster risk financing strategies. So these efforts provide critical insights into insurance coverage, exposure, highlighting the need for broader risk management solutions. So I think that's sort of the first approach that will be important. The IAS has also collected data with respect to NatCat, which feeds into the global monitoring exercise that the IAIS publishes. And this will sort of illustrate what the market trends are, the developments, and detect the possible buildup of systemic risk in the global insurance sector. Second one is the importance of financial literacy. This is very important. Financial literacy does not solve this problem by itself, but it is something that is essential, and it might take a lot of time actually to make sure that people are well informed, well educated about the importance of insurance. A lot of people think about, lending. That's always important. Bank lending, credit, always important. But do they understand that insurance is important for them? That's probably not always the case in every jurisdiction, including in EMDs. So this is something that would be very important. I think it's a prerequisite for success of any insurance-based solution. And I think it's very important that we disseminate about the value and the importance of insurance to households as well as corporates. The third point, supervisors can encourage insurers to integrate incentives for risk prevention in their product design, as well as underwriting and pricing practices. For example, Andrew mentioned about Flood Re. Flood Re is a regulated entity that allows the cost of property resilience measures to be included as part of repairs up to a certain value beyond the pure reinstatement value. I don't know if Andrew agrees. Build back better, maybe in that sense, from Flood Re. So I think that's a very important point as well. Fourth is about to support the availability of insurance and uptake of coverage, including through supporting the development of innovative insurance products. Lesetja, I think, mentioned about the importance of parametric insurance, which is could be a powerful tool to help vulnerable segments of the society to receive help when needed in a very quick manner. Of course, there's always a communication issue, transparency issue, accountability issues associated with this, but it can also be a very helpful tool on this. And as Andrew mentioned, I think there's importance about having what we call in our world risk-based pricing, because it encourages policyholders to build better homes that could reduce your premium. So in that sense, a conversation between insurers as well as households, corporates, can actually help the society to build better infrastructure. And this is something that I think is a very important role that insurers can actually play in this context. Last but not least, public-private partnerships. Let me encourage people around the table to have these supervisors involved in any kind of discussion about public-private partnership, because we can be helpful perhaps in the design and implementation of public-private partnerships, particularly on insurance schemes. Last year, alongside with the OECD, we supported a G7 publication under the leadership of the Italian Ministry of Finance of a high-level framework for public-private insurance programs against natural hazards. The complexity of the underlying issue means that addressing protection gaps requires a coordinated response. Finding solutions absolutely needs to be a multi-party effort. We can't do it alone. Nobody can do this alone. So it's natural that this is a multi-party effort. And I believe there's a great alignment here. There's a common goal. The common goal is that we need to narrow down the gap. And there's a common goal between policymakers, the insurance industry, and indeed us, the insurance supervisors.
Great. Thanks. Maybe actually, Ricardo, maybe I could go to you next, and then we'll come to Hatice, because we've finished on this message around public-private partnerships, and as Shigeru referenced, obviously the G7 high-level framework on public-private insurance programs against natural hazards, which was very powerful last year. But then, as you referenced, Italy has its own experience with PPPs in this area. And what is the thinking on the role that this can play in addressing protection gaps, particularly in areas that would otherwise really struggle to have insurance?
Well, most of the points have been mentioned by Shigeru and the other speakers. It's clear, I mean, one of the things that emerged from the work that was done by the OECD, the IAES, and others in preparation for our G7 paper. And then there was actually a follow-up World Bank paper for emerging countries. Is really, the key point is this collaboration among the different actors. So you design your policies, hopefully in a close to optimal way, which means you need to take into account the perspective of regulators, supervisors, the insurance sector as well. Among the things that emerged is certainly the need to have better financial literacy, data availability, capacity within the public sector, and the ability to pull risks at the regional level. And clearly, the more diversified the risks are, the broader the region, the more effective the policies. So more specifically, what role can we play? It's clear, first of all, the public sector as the alternative in the absence of insurance protection of facing very significant expenses that are unpredictable, can hit the public finances very severely. So it makes sense to use public resources to integrate whatever, or to provide whatever protection or additional contribution is necessary to make the products work. And I think this is also a lesson in terms of our development aid, that perhaps we can maximize the impact of our resources by making that type of contribution, trying to build markets for insurance, so with all the necessary ingredients that I mentioned, like data, so that then our contribution can be maximized. So I would say I mentioned earlier the fact that we do have some experience in different types of risks, from flooding to fires, earthquakes, and they are not necessarily spread evenly across different regions. So, the experience with providing the necessary addition to make the product viable from an economic point of view is essential. I think the other point that has been mentioned, which is quite important, but I also said it earlier, that if the private sector has some skin in the game, then the behaviors and the investments in prevention will be appropriate. Because what we have, I think, for any risks that we can think of is that, at least in our country, there is always an expectation that the government will foot the bill. And we need to change that culture so that people know that if they invest in making their homes more resilient or rebuilding, then they will pay a very low premium. And reverse a little bit the logic whereby we're always expected to provide incentives to make property renovation investment, like we did in recent years with significant burden for the public finances. So I don't know if I answered your question, but I think we do have a clear way forward in terms of how we use public resources domestically and also to support emerging economies and developing countries in general. Thank you.
Great. Thank you very much. And then turning to you, teacher, and keeping with the theme of practical examples of practical solutions in this area, and of course in Turkey there was the tragic major earthquake in 2023, and based on that experience, what lessons would you say are there for other emerging markets, perhaps sitting in this audience, thinking around how to prepare for this, and the lessons regarding the design of how to respond to disasters, post-disaster policies. Maybe to you on that.
Thank you for asking this, because I think a dramatic example of the economic and human cost of natural catastrophes is the twin earthquakes that struck Turkey in 2023. This was a tragedy in every sense, marking one of the deadliest and most economically damaging disasters of the year globally. Let me first help you imagine how severe it was. The earthquakes claimed over 53,000 lives and caused widespread destruction across 11 provinces, representing 16% of Turkey's population, 16%, and 10% of its GDP, and 11% of its formal employment, and 9% of its total exports. The region as a whole, these 11 provinces, was an important center for domestic economic activities and also export activities, particularly in the sectors of textile, food, agriculture, livestock, paper, and iron and steel. And for some of these industries, the region was not just important, it was the main supplier within the country. And the region's significance as a national supplier meant that the disaster quickly became a supply chain risk of both domestic and international concern. And again, this was the most devastating disaster worldwide in 2023, accounting for 62% of all disaster-related fatalities in the world and 24% of total global economic losses, with damages estimated at $92 billion. And the International Labor Organization estimated that 16% of the jobs in the affected area, which is equivalent to over 650,000 full-time positions, were lost. So this was the case we faced in 2023, and in response, both the fiscal and monetary authorities in Turkey moved swiftly to cushion the blow. On the fiscal side, in 2023 alone, the government allocated emergency aid or relief spending equal to around 4% of GDP. And I think this highlights the significant fiscal burden natural disasters can place on public finances, especially when sufficient risk transfer mechanisms are not well in place. At the same time, the central bank, of course, adapted rapidly by adjusting macroprudential regulations to exempt firms and individuals in the affected region from loan growth caps and extended maturities for repayments of rediscount credits in the earthquake zone. And these measures, of course, aim to maintain financial intermediation and necessary financing throughout the reconstruction phase. In addition, that restructuring was a part of the relief program. Labor market policies, they also helped a lot, played a crucial role in preserving livelihoods. In affected provinces, access to the short-term working allowance was eased by waiving the waiting period, supporting like 111,000 workers whose jobs were at risk due to business interruptions. And for those not eligible, a cash wage support scheme provided additional income for 82,000 people. That said, this disaster also reaffirmed the importance of pre-disaster financial preparedness. So it's important to underline here the importance of the role of risk transfer mechanisms, particularly in our case, the Turkish Catastrophe Insurance Pool, TCIP. The TCIP was designed as a mandatory earthquake insurance scheme, and I think it's a good example of public-private partnerships because the pool is regulated by the state to provide affordable and broad protection for residential buildings. And in the affected region, 1.1 million active policies were in place before the disaster. And after the disaster, payouts were made on approximately half of these policies, highlighting both the value of such mechanisms and the need for broader coverage, because as of 2024, the coverage rate for this pool, for this mechanism across the country stands around 56%. So there is some room for improvement. Well, despite these extensive efforts and interventions, I can say that the economic aftershocks were still significant. First of all, as I mentioned, fiscal expenditures surged, widening the budget deficit and delaying the expected moderation in domestic demand. Second of all, rent inflation, already elevated before the disaster, remained a major driver of inflation persistence throughout the country, and we're still dealing with it. And number three, supply chain disruptions. They were felt nationwide, even with targeted debt relief and restructuring programs in the affected region. So I guess these efforts and all these effects and efforts clearly demonstrate how natural catastrophes can create complex spillovers requiring good coordination and coordinated responses across monetary, fiscal, and supervisory agencies.
Great. Thank you very much. And now we will enter into the last round of which will be a little bit like quick-fire questions, because we'll ask for a response in about a minute or so each. But the theme has been about action, and we've realised the problem. There are solutions, but now we need to act. So if I could ask each of you in turn to perhaps recommend one key action or priority to address Nat Cat insurance protection gaps, what would that be? I don't think we have a particular order for this one, so who would like to go first? I mean, Antoine, we haven't heard from you in a while.
I was not aware that I would like to start, but I will. I will. No, to quickly answer your question, I think the bad news is that disaster, natural catastrophe will certainly continue to increase over the last 5 years in volume and in severity. The good news is that there is the collective sense of awareness is progressing, and our meeting is clearly showing that. And for me, the two main priorities are first to reduce the impact of events, notably through more investment in resilient infrastructure. And the second priority is to reduce protection gap through innovative insurance solutions from a technological standpoint with the parametric offers, but also from a financial and legal one with innovative approaches, mixed approaches between public and private. And we also need an active help of supervisors. They have the expertise, and they can facilitate the implementation of new solutions. So what does that mean? That means that we really need to work all together, public, private, supervisors, and so on.
Thank you. Ajay, maybe.
Okay. So if I had to identify one key action to close Nat Cat insurance protection gaps in the medium term, actually it's difficult to answer this because adaptation is crossing my mind, but I guess I'll go with public-private partnerships because the success of public-private insurance schemes offers valuable lessons. That's what I think. And PPP projects are especially beneficial when they include compulsory insurance systems established by the state to protect society against these risks, while operations such as policy insurance and premium collection, they are carried out by private insurance companies. But more importantly, these partnerships must focus on delivering scalable, affordable and accessible coverage, especially for the most vulnerable. And of course, this requires designing innovative insurance schemes that can be expanded rapidly and supported by governments. Of course, it's not an easy job for every jurisdiction. So for this to be done, number one, institutional capacities should be improved in terms of technical expertise. Number two, data should be improved because healthy insurance pricing relies on healthy and reliable data, and this is especially more challenging in developing countries. And number three, financial literacy gaps. They should be narrowed to help households and businesses fully understand insurance products or their value. And this very framework is actually also recommended by the World Bank for the effectiveness of PPPs in the insurance sector. So I believe that by seriously addressing these barriers, we can transform isolated successes into national and global standards for climate resilience. I think I listed many actions, but actually there are sub-actions. Thank you.
Great. Ricardo.
I have a quick go. When I think about, and I partly mentioned before, but when I think about the domestic sphere, meaning our own case, I think rethinking the protection of private property, of residential property, is one of the key challenges, how to combine tax incentives and perhaps a gradual move towards compulsory insurance protection. And at the international level, I think we now have quite a bit of work that has been done on the PPP's idea. I think going ahead and implementing a first set of projects that perhaps would go beyond a certain country in a certain sector, would be broader, and perhaps also start thinking about what I mentioned earlier, the regional protection schemes, where you can pool risks also across countries. I think that would be quite useful.
Thank you. And Shigeru.
Thank you. I think Hattis took my words out of my mouth. So I do agree that public-private partnerships will be quite important. But let me emphasize the part, not about public and private, within sort of a government as a whole approach, because supervisors can and should discuss with not only Ministry of Finance, because Ministry of Finance would be important, of course, from a public finance point of view. But in the end, it's about how do you make sure that you have a resilient infrastructure in place. And that is the key to narrow down actually protection gap in a medium to longer term perspective, which means that we should also, of course, there are a lot of people from the Ministry of Finance here, I think, but also with other relevant ministries who are in charge of building resilient infrastructure. And I think that part should not be overlooked. In terms of enhancing the resilience of the infrastructure itself, which would actually help narrow down the protection gap. Another thing I want to emphasize is our work with the World Bank Group. We have been working to develop practical tools, resources, which can help all the countries, including particularly EMDs, under President Banga's leadership. We have worked a lot with Pablo Saavedra, who's not here, the VP, worked with Laura as well. So we continue to look forward to exploring further down the road what we can do and what we can publish. That will be useful for not only countries or governments, but also for the private sector as well as other stakeholders. And we look forward to further work on this.
That's great. Well, I would like to say thank you to a fantastic panelists. And to wrap up, I think we've heard a lot of consistency here in terms of, firstly, this is a challenge that demands action, fiscal reasons, financial stability reasons, but social welfare reasons. And secondly, the importance of partnerships in tackling those solutions. And we've also heard that inaction is not an option, that we do need to work together across stakeholders because of the potential impact on financial stability, but of course as well as the human cost. So, but I think the good message is, and to echo Antoine's words, I think that we have heard from all of our keynote speakers and our panelists that there is a commitment across sectors to take this action and tackle the challenges. And as Shigeru said, from our side, the IIS, with the fantastic partnership with the World Bank Group, we will have the input paper that we did for the Sustainable Finance Working Group will be published next week. And the next step will be to move to a sort of toolbox or handbook of practical examples for supervisors and policymakers of what can be done in practice, learning from the lessons of others, working the IIS, the World Bank, other partners like the OECD, the IDF, to really start to provide very practical resource for jurisdictions to take it forward, taking into account their individual jurisdictional circumstances. So we look forward to that, the continued work, the continued commitment to tackle this challenge. And with that, I now close the event and thank you all for joining us.